Hello everyone, this is module 8 of comparative financial systems. In this module, we will cover financial system and financial institutions, and our focus will be on non-bank financial institutions. In this lecture, we will cover investment banks. Let's look at the agendas of this module first. First of all, we will cover investment banking. Then we will look at investment institutions, which include mutual funds, hedge funds, and finance companies. And finally, we'll look at contractual savings institutions, which include pension funds and insurance companies. Let's look at what is an investment bank. An investment bank is a financial institution which is usually involved in underwriting new security and providing advice on merger and acquisitions. An investment bank is usually involved with a range of activities. These include providing advice on new security issues, underwriting new security issues, providing advice on merger and acquisitions, financial engineering, which also include risk management, and finally, investment banks are also involved in financial market research. So first of all, investment bank provides advice on new securities issues. So firms turn to the investment banks for advice on how to raise funds by issuing a stock, bonds, or by taking bank loans. Then investment banks also provide underwriting new securities. In this case, investment bank guarantees to the issuing corporation the price of a security, and then they resell the security for profit. Investment banks also helps firms to issue IPO in the financial market. IPO means whenever firm issues security for the first time. In that case, firms need to maintain some sort of formalities. Investment banks help the firms to maintain those formalities on behalf of the issuing corporation. So, what are the benefits of investment bank? An investment bank typically earns 2 to 4% of the money that they raise in a secondary offering. And investment banks also takes the risk that it cannot profitably resell the securities being underwritten by the investment banks. Secondly, investment banks also provide advice on merger and acquisitions, and in this case they help both buyers, that means the buy side mandate, and the sellers, that means the sell side mandate. In the event of merger and acquisition, investment banks helps the firm to find out an acquiring firm willing to pay significantly more than the book value of the firm. So their task is to find a firm for the acquiring firm which will provide more than the book value of the equity. And in this case, providing services like merger and acquisition is profitable for investment banks because in this case they do not need any sort of investment. Only cost which are incurred by the investment banks are salaries of the investment banker, whereas when investment banks provide underwriting services, they need investment. But when they provide services like merger and acquisitions, they do not need any sort of investment. Investment banks are also involved in financial engineering. Financial engineering means developing new financial securities or investment strategies using sophisticated mathematical models. Derivative securities are also kind of a product of financial engineering. And finally, investment banks supply the knowledge of financial market to properly assess the best way to raise fund and to how to manage risks. And in both cases, investment banks charge fee to the service holders, or that means the firms that take services from the investment banks. That's all about this lecture. In our next lecture, we'll look at investment institutions like mutual fund, hedge funds, and finance companies.